COVID, stimulus packages, market chaos, global shutdowns. At least you've heard mortgage rates are good, right? Well, it's actually a trick question. So rates are definitely incredible, between 2.25 and 3.75% on a fairly daily basis is what I'm seeing. But there's a pretty significant catch, and people need to know that. So as most of you know, rates cost points, a percentage of the loan amount in exchange for a difference in the rate. Historically, the rates lenders advertise would be the one that costs no points. Important to note that closing costs are a separate thing. No points just means the rate itself doesn't cost anything. The 0-point cost is known as par. The problem right now is par value doesn't even exist in the majority of loan programs out there nowadays. So rates are unbelievable, but only if you're willing to pay the 1 to 3 points it takes to secure it. And the thing that bothers me is that we could have done this 6 months ago, 12 months ago. You know, you can just buy down the rate. So why is this happening? Well, short answer, banks and investors are scared. There's two primary reasons why. One, there's immense pressure on entities called servicers. And two, investors have a major fear of what are called early payoffs. So to understand both, let's quickly oversimplify the nation's mortgage system. We'll start here. So you are trying to buy a home up here with a loan that you get from a bank. Okay, so this is how it works. The bank gives you money, you buy the home with that money, and in return, the bank gets your monthly payments plus interest. As we zoom out, you'll see that the bank gets your loan and other people's loans, and they actually don't hold on to those. They almost immediately turn around, like within 30 days, they'll turn around and sell your loan, the rights to your payments, to another entity. You can think of this entity as Fannie Mae, as Freddie Mac, as the FHA, as a private institution. They take a bunch of different forms, but bottom line is these institutions exist to buy these these loans off of these banks so that the banks can essentially replenish the money that they gave you and go do it again. And then they receive a little bit of a profit when they sell it to the institution. After that happens, this institution, most of them, their job is to package all of these loans into what we'll call a portfolio and slice that portfolio up into little bite-sized pieces and make these pieces available to the bond market for common investors to buy. So when it's all said and done, and the loan has completed its journey, it looks something like this, which is basically you paying your monthly mortgage to the investors that have bought pieces of it. Now, let's also consider the tedium involved with collecting mortgage payments, facilitating foreclosures, paying taxes and insurance and escrow impounds, and all this other stuff. Banks and investors aren't in the business of facilitating your loan. They're in the business of giving you a bunch of money, turning around and immediately selling your loan agreement to someone else, and then replenishing that value plus a little bit of extra. That's where their profit comes in, so that they can essentially just go do it again. Wash, rinse, repeat. If at the end of the day, the structure looks like this, you're obviously not paying the investors directly. So we need an intermediary to facilitate that processing. Enter the servicer. So the servicer you could think of as a lot like a leasing company, actually. So, when you're paying rent, you don't pay the building owner or the investors directly. You pay the leasing company or the property management company. And they in turn collect all of the rent payments and then distribute those proceeds to the building owner or investors, in addition to all their other responsibilities. In that way, you could think of servicers and property management companies as being really similar. Operationally, though, there are a couple key differences. Most notably, the servicer is responsible to pay the investors whether they get payment or not. So, for example, if a tenant can't pay their rent, then the property management company doesn't have any rent to forward on to the employing landlord. Servicers, on the other hand, their contract is more so these investors that have these bonds are expecting a return, and they're going to get that return. So if somebody doesn't pay their mortgage, be it for forbearance or deferment, then the servicer has to spot the difference. Naturally, if 7% of all mortgages are in forbearance or deferment right now, servicers are having a really tough time. Which means the servicers have to charge more. And because the servicers are charging more, the lenders have to charge more. So they pass that cost along to the consumers in the form of points. Now, the other issue is early payoffs. An early payoff is a loosely defined term that just means a mortgage has been paid off or refinanced earlier than expected. As you can imagine, banks and investors don't make a whole lot of money if you're only in their loan for a year. Were it not for the economic turmoil that's going on right now, par value, meaning no points, par value mortgage rates would likely be at historic lows. And this presents a pretty big opportunity for consumers that are paying attention and can do the math. To illustrate, let's say you're 3 years into a 30-year mortgage with a 4.5% interest rate. If you were anticipating rates to go down over the next 6 to 18 months, and you could get into a lower rate mortgage right now for no points, wouldn't it be awesome if you could just do that and then hang out until rates go down even further and then just refinance again? Or better yet, you could take a 3.75% interest rate and get money back from the lender, offsetting your closing costs. So you're saving money with the 3.75 rate versus your 4.5. You're saving a couple $100 a month. Your closing costs were paid for, literally free money.
It's free real estate.
And you're just waiting to refinance again in 6 to 18 months. Yes, for you and for me, it would be awesome. But the banks and investors, on the other hand, get shafted. So in order to stay in business, they need to reduce the amount of people riding that wave as much as they can. So at the end of the day, between these fears of early payoffs and the immense pressure that servicers are under, banks have jacked up their point values to quote unquote hedge, it means protect, themselves from bleeding more money than they already are. So I hope this was helpful, and I hope it answers more questions than it probably sparks. Thanks.